All right, everyone, welcome to Charts and Chats with me, Gordon Scott, and with you. I'm glad you're here. This is going to be fun. At least it will be fun for me. I hope you'll enjoy it too. I've got here a large screen that I'm going to try and point to stuff with. We're going to see how this mode works, and please chat in whether or not you like it by the end and whether or not you think it's useful. Let's start right off with the countdown to Doomsday, Doomsday being 14th of May. If you missed it last week, you should go look for the link. It's still out there on YouTube. Full on recording, complete description of what my 56-week pattern is and why it is ticking down a time clock, a alarm clock that is set to go off May 14th. And why that means if you've got money in the US market, you want to maybe not have it there in the same places anyway. You want to be prepared for a significant downturn. This downturn may not come, but if you think it's not going to come, you better watch last week's recording so you can at least be informed about why I think it is going to come. And last week was rather bullish, but does that change anything? Not a bit. In fact, I'm going to show you a few reasons why it confirms it. But to give you a short version, let's go back to the reason for why this is all happening. Down here on this part of the chart, we've got this sort of amber region, or whatever color we're going to call that. And what that is represents a 20-day period where the market rose by 7% or more. In this case, it rose 28% in 1 month. That's the bottom of the post-pandemic low, and coming right up off of that for that month for the S&P 500. Now, you go back 100 years and check the data yourself, and what you find that is any time that the S&P 500 goes up more than 7%, then 56 weeks later, the average returns for the 1 to 2 month period following 56 weeks from this moment is below average, significantly below average. I mean, look at it this way. The average return for the S&P over the course of a month is about 0.58%. That's all years, every month, every possible permutation of a month, all averaged together. It's about 0.58%. And that builds into something like a 7% average incline for the S&P 500, again, over the past 100 years. But the month that follows is either flat or negative, that follows that 56-week pattern. So over all those years, that's how much difference there is. Big difference. In fact, there's very few other price actions that I've found that persistently make such a negative impact. And so this is the short version of why. Now, what's interesting here is that, COVID was this weird thing, and it did weird things in the market. So yeah, no big surprise, right? Maybe it just created this totally unnecessary drop, and then the rebound wasn't something that was normal and shouldn't be counted as normal. That's a fair possibility. And yet, we will see this week how we're already seeing signs of people getting ready to take significant profits and to sell. So that's where it got started, all right? But here's the thing I didn't share last week. Here's the thing. These three sections right here that follow right behind this 20-day period. There are 3 more 20-day periods that all occur within the next 3.5 months after the March lows of last year. Well, it was a lot of rebound, but each one of these is more than 7%. A couple of these are double digits. So what does that mean? That means we have this big month that happened, and another big month, and another big month, and another big month. What happens is that when you get a bunch of people buy in at the beginning of this 56-week pattern, that month that goes flat at the end of the 56-week pattern is these people wanting to take profits because they want to hold on for 1 year and they want to maximize the tax impact or minimize the tax impact. They want to get long-term capital gains, which they can't get if they sell in less than a year. So a lot of high net worth individuals, a lot of mutual funds and hedge funds and large investors who are all playing the game that way, when they buy in here, they're going to let the clock tick. Well, not only that month, but you see the next month, and a little bit more in the next month after that. So what does that say? This says bear market coming. Now, I kind of think that this isn't going to really happen. We're not going to get this huge bear market all the way through the summer because this is a COVID thing. This is just an aberration once in 100 years, right? Literally, you got to go back to the Spanish flu. But I kind of think that we need to watch out for that. Meanwhile, let's have a look at what's going on right now so that you can see for yourself what I'm talking about here. We got a chart of the futures. This is a 15-minute chart of the futures. That's where the weekend changed, okay? So this big run up for Friday, and then what's been happening since? Well, we're drifting a little bit lower. So people got pretty enthusiastic last week. The S&P 500 really ran up high, and not just the S&P 500, but the Nasdaq and all U.S. indexes really kind of had a strong move through the week last week. But since then, coming into the weekend, it's not this continued euphoria. Well, I don't think that this means we're going to sell off. We're probably going to see a little bit of buying this week, some strength, but we're also going to see some selling and some sort of back and forth a lot for this week. What's happening this week in the U.S. markets is earnings. Earnings season will start. Earnings season is, once every 3 months, you get, and companies are always reporting their earnings all year long, right? What's unusual about earnings season is the Dow components, the 30 stocks in the Dow Jones Industrial Average. Those stocks all tend to report at the front of those 90-day period. And in fact, the Nasdaq 100 and the S&P 500, all the big household name stocks, Apple, Microsoft, Tesla, et cetera, right? They all kind of report towards the earlier edge of that 90 days. And so that's what's going to be driving the markets for the next 2 or 3 weeks is the reaction to the earnings reports. And the first 2 earnings reports that kick off this flurry of new information are on Tuesday. Tomorrow is JP Morgan and Wells Fargo, the 2 big banks. So the financial industry, you get Citicorp and Goldman Sachs and several others, all kind of, they'll all happen this week. So the financial industry will really kind of show its cards and let everybody know what has happened for them over the past quarter. Now, I fully expect that people are going to be surprised at how good things went over the past quarter. Why do I say that? Well, because towards the end of the quarter, that was already happening with other companies that were earning, lesser known companies that were late in the first quarter. So the second quarter, I'm thinking is going to just be more of the same. I'm looking around and jobs are plentiful. I mean, you hear a lot about, the economy is tough and we're not recovering as fast and blah, blah, blah. Yeah, the energy, the travel sectors, maybe those places. I got to tell you, if you were trying to start up a business in the United States right now and you were trying to hire people into it, you'd be competing. You'd be competing with a lot of other people that want to do the same thing. I have people emailing me and I am emailing other people because I like to connect people with jobs and references. And I've just been really shocked at the flurry of hiring and seeking that is going on right now. So I feel like people are either really rolling the dice, trying to ramp up and expect things, or they're already seeing indications that, hey, this could work for us. Let's go ahead and give it a try. I mean, when you start hiring people, lower end people, then, that's not super risky because, hey, things don't work out. You're not out too much money. But that is who's hiring right now. The lower end is really starting to bring back. And to the extent that that's going on, I don't think it's I don't think it's people taking a calculated risk. I think they are seeing the comeback. And restaurants, they're opening up. Travel bookings. If you call any one of the major airlines and say, "Oh, COVID, things got canceled. I want to cancel my flight," they won't let you cancel. They don't have to give your money back. I mean, they'll give you a credit. They'll be accommodative, but they won't just flat out cancel and give you a refund. Those days are over. Why? Because the demand is high enough. So all of this is going on, and I think that we're not going to see terrible results for earnings. We'll see what the tech companies start lighting off in the 2 and 3 weeks out from now. We'll see what they do. But the financial companies, I suspect, should turn in better than expected earnings reports. I think that they are actually going to surprise people to the upside. Now, just because they turn out good news, does that mean that the markets will go up? No. I mean, markets are weird that way, right? Remember what I said last week. People get a decision in their minds about what they want to do, and then they go looking for evidence to support that decision. This is called confirmation bias. One of the strongest behavioral finance influences in trading. Confirmation bias means people go looking for things that support their opinion. And so what's really going to happen here is, let's suppose JP Morgan says we're killing it. We came out with this fantastic quarter this past quarter, and here's our numbers. Well, we watch what the price does in response to that. That's what we care about. And if in fact they start selling, right? If investors start selling on the fact that JP Morgan beat their numbers, that would be kind of weird. That would be, you would expect price should go up. If what we see is price goes up a little, or maybe it gaps because JP will report before the market opens. So let's suppose JP Morgan gaps and then falls throughout the day. People are selling off into the good news. What is that behavior? That behavior is so consistent. It has a very clear message. The message is, I was buying the rumor, I'm selling the news, right? These are professionals that are saying, okay, the news is out. It can't get any better from here. Now it's time to take our profits. Why would they be taking their profits, right? If the news were good, hey, that stock could rise for another year, right? So if in fact the news is good and they sell, then it means they have something else in mind. They have some other plan. They believe that's as good as it gets, at least for a while. And we're going to be looking all this week for stuff like that, for things to come along. Yeah. So I've got a few chats coming in. Thank you, everybody. Some great comments. Let me just get through these. So Helen's saying, hi, Gordon. What does it go flat at the end of 56 weeks? That's the month that occurs at the end of the 56 weeks. April, do you think taxes have an impact too? Well, remember, in the US, tax deadline got pushed back 1 month. So people don't have to pay taxes until May 17th, or they're not going to get their return back until May 17th. Do I think that tax deadline is going to have an impact here? No, not really, because when the tax deadline comes and people have to pay taxes out, they're already planning on having to pay that. They're not spending that money if they know they have to pay. How about people getting their returns back? Well, they won't get their returns back if they wait until the end, which most people do, to file. They won't get their returns back for 4 to 6 weeks afterwards. So if people get a lot of money back, which there'll probably be a lot of people to get money back this year, because all the tax laws were very accommodative because of still COVID, et cetera, et cetera. So if in fact they get money back, they're like, wow, I got this return. Now I want to put it into the markets. I want to buy crypto. I want to buy stocks, or I just want to fix my house with it, right? Any one of those three things happens, it's bullish for the US markets. And that won't happen probably until June or July that we see that kind of money come in. So if it has any impact, it's delayed. It won't come until a little bit later. Yeah, so between now and then, volatility in the markets. Ellen says she read a report from FX about the 100-year war cycles, I haven't seen that report. Tensions between Russia and Ukraine, China, Taiwan, Iran, Israel, cyber attack, so forth. Is that fear in the market? Not yet. You'd be amazed. Go back and look at the S&P 500 chart for World War II, years of World War II. Not just the US, but any market. But in particular, what you'll find in the US market is that it bottomed in 1937. And if you were a buyer anytime after 1937 and you held through the war years, you did great. Those are some of the best years of the past century. And so what's going on there? People are afraid of the war. Why is the market so strong during that time? The answer is that politics have less impact on markets than you might imagine. And that's the short version of it. But yeah, so anyway, what do we got going on right now with politics and with taxes and laws? Again, you'd be surprised how little that has an impact. The whole COVID thing has a lot of impact, but it's not because of what the politicians are doing. It's because everybody is reacting to this. Everybody's reacting to it at the same time in a similar way. All right, Roy says, hi, Gordon. If one had to triangulate, how else can we arrive at the same conclusion? Conclusion of selling, you mean? Well, I don't know that I can speak to a 56-week pattern triangulation, for corroboration. But what we can at least do for right now is, again, look at things that are typically correlated. So let me just take you to a chart I've got here on this one. Yes, this is okay. You've heard me talk about this a lot. Aussie yen and the Nasdaq are highly correlated. Okay, I don't know if this is going to work with my my colors on my chart. Let me see if I can. Sorry, I'm going to do a little bit of jumping around here, but I've got a problem there that's going to throw that chart off. Okay, this will do a little better. All right, so the Aussie yen is this blue and orange set of candles. I've tried to kind of put them together next to the Nasdaq, the red and green candles. And so what do we got here? These things are better than 75% correlated, the Aussie yen and the Nasdaq. Over time, they stay pretty close to each other. Now, 75% means 25% divergence going on all the time, right? Right. So if it diverges, it's not the end of the world, but you pay attention. You look and see if that divergence persists and whether or not it begins to have an impact. So far, we've got the beginnings of a very important divergence happening just this past week. As we mentioned, the past 6 or 7 sessions on the Nasdaq look pretty vertical, right? Now, in truth, we're just getting back to an old high. It's kind of interesting. S&P, Dow, they're making new highs. Nasdaq just barely getting back to its old high. But the yen, the Aussie yen, what it did, it had this big sell-off day, which did not correlate to something, to a major sell-off in the Nasdaq. And then, more importantly, the last 5 sessions on Aussie yen are drifting lower, while these are drifting higher. That important divergence is very meaningful in my mind, because what it says is globally, we don't have the same enthusiasm for stocks that the US markets might have locally, that is, among US investors. So we will see whether or not this isn't so much a gauge for interest in US stocks, because it is the Aussie yen, right? We're talking about Australian dollar and Japanese yen. How does that relate? This is the global carry trade. This is just the worldwide investors. It's a good proxy for the worldwide investors' approach and attitude about taking risk in general. So they're kind of tapering off. They're like, I don't know. Whereas up here, it's full steam ahead. See, that divergence can't keep going for an extended period of time. And so we've already got some sign of nervousness, and we're looking, Aussie commodity versus the yen, right? You've got some interest and positive interest on the yen, on the Aussie, and negative interest on the yen. That's what creates that carry trade. Okay, so About right now here, I want to bring in my guest. I have a special guest with me, Glenn, Glenn Serow. Glenn is a friend from a long time back, formerly a student of mine, is now gone on. He is the senior coach for the coaching program for Guy Cohen. You might know him through Options Made Easy or some Flag Trader, another one of his websites. Guy Cohen's also a good personal friend of mine. And I introduced the two of these gentlemen because Glenn had become quite a competent trader in his own right. And now he's a teacher of other trading systems. Glenn, are you there? It's good to have you here.
Gordon, I am here. Can you hear me?
I can, yes.
Oh,
Hopefully
good.
everybody
Okay.
else can hear you too.
Very good. Gordon, thanks for having me on. Always a pleasure. Everybody should know that you are a very big name in stocks. I mean, I've followed you also for many, many years. You were a great coach, and the things that you bring up are great. I
Thank
guess
you.
I guess I have a few things I can say here.
Yeah. So you've got to let me kind of tee you up a little bit here. When we had this conversation last week, Glenn, you and I was asking you what's something that you like to teach students now, something that you felt helped you and that you find when you explain, when you coach people one-on-one really helps them. And from your response, I thought was interesting. I mean, I've heard it a lot of different ways, but I was interested in your take on it. You had, well, why don't I let you share it, Glenn? Tell us about how seeing what the charts are telling us is
Uh,
come from you.
Yeah. I'd like to talk about trade plan too, but we'll come back to that. But yeah, trade what you see. It's an interesting concept, and listen, like you said for like the conversation we had, why it's always about the why. I mean, I can tell people, look, just trade what you see and don't forget, just forget everything else. But it's interesting because, in fact, this chart that you're showing right here is a perfect example. We might have an opinion of what the market's going to do. We might have an opinion, as you were talking about earnings, what a stock should do after the earnings come out. But it really doesn't matter what we think. It matters what we see in the chart. The charts speak volume. We're technical guys. There's a fundamental side, that's fine. But the fundamentals really should show up somehow in the chart. If a stock comes out with great, quote unquote, I always love to hear that, great earnings. Well, what are great earnings? It's a subjective term. You know, there are mutual funds, hedge funds, pension funds that own literally hundreds of millions of shares of different types of stocks. We might think the earnings are great. Apple's supposed to, let's just say, for example, and this is just, I'm pulling this off the top of my head. Apple will say that this next quarter is supposed to come out with $1 share. I don't know what it's supposed to be. Let's say $1 share. And it comes out with $1.03. And we own 500 shares of Apple or 1,000. And we're like, woohoo, let's go. This is great. Announces before the market opens, Apple drops $10. And we're scratching our heads. We're saying, what the heck? Why? Because the guy who's got 50 million or 100 million shares, he doesn't care about the consensus on the street. He's got his own analyst. He says, hey, I'm looking for $1.07. $1.03 doesn't work for me. So sell 50 million shares. So again, it's trade what you see. And this chart, again, if we think the market should go up and this chart is saying, well, maybe there's a little bit of hesitancy, maybe we should see, take into consideration what this chart's telling us. That's really more important because the big guys are moving the market and they're going to leave footprints in that charts, whether it's volume or certain patterns or things like this, divergences. These are the things that we have to look at and kind of forget what we're thinking because it's not our job to move the market. It's the big guys.
Our job to react and profit from it. Right.
That's right. I don't know if we can bring that chart up. Can you bring up Neo?
Yeah. Let me see if I can. You had talked about wanting to look at NIO. I'm sure this is familiar to many people. We're looking at this from November on a daily chart. How does this work for you, Glenn? Do you want to
Can you go back a little further? Maybe back
Okay.
another year almost, or to the beginning of last year, where it's really kind of flat.
All Righty. We'll get back to here we are during February of last year, coming up to August. That
Yeah,
works.
that'll be good. That'll be good. Can you put volume on that chart? Is that possible?
I can. Let me bring up the indicators here. All right. Hopefully you're seeing the volume pattern down below.
Yeah, it's beautiful. All right. So, here's a great example. And, certainly not a recommendation, but a great example. Back here in April, the stock was, and your chart's a little fuzzy on my end. Was it like $3, $4?
$3 line right here.
Yeah. And prior to that, oh, it looks better now. Okay, zoomed in. Prior to that, it really was in that same area. It's $3, $4 for months and probably years and before that. And at that point,
Right.
Nobody knew, what NEO was. And then all of a sudden, you can see the volume pick up. Big increases in volume and spikes, and you can see the stock go from 350 to eventually, if you can scroll that chart to the left, you can see it go to, I think it went up to about $65. Yeah, there you go. And you can see all along this way, how many times could we have said, hey, this stock went from 3 to 10. That's, I don't know, through 200-300%. Gee, that's a lot. And when it goes to 20, you say, whoa, that's really a lot. And then it went to 30, and then it went to 40, and then it went to 50. So how many times, if we had just said, I think this stock is going up too much, we would have been wrong. And you can see the volume pick up. There are legitimate reasons why. There are legitimate patterns where we could have entered. And the bottom line is, this is what it's all about. Apparently, the big guys continued to buy it, and we could have rode along in their coattails on a stock that went up like 1,000% or more. Right.
Have you noticed, Glenn, also on volume, since you're talking about it, one of these things way back here, this has been such an important and reliable indicator for me over the years. When you're talking about something that's low priced, something that's not in the public eye, and then all of a sudden you get this huge volume spike, and makes the stock run up 50, 100%, whatever. Then what I notice is that after that volume tails off, after the big spike is done, if the average level of that volume hangs around and the price doesn't drop back to earth, then that's the potential for it setting up to go even more. Have you noticed that as well?
Absolutely. Yep. And you can see the overall general volume for months and months and months before June were very low, and then the average volume, going forward, much higher. Yeah.
I thought that was, there are very few things that I found that are precise about volume, but that's one that has kind of stuck with me over the years, is that especially for low price stocks, when you see that dynamic happening, it's not 100% that it's always going to keep going up, but it's like better than 50%. It's a good probability, it's a good risk to take. And so, you set your stops and so forth. But then here, as you pointed out, once we start approaching the top, we get this big red chimney stack, a big sell day, which hasn't come up. I mean, we've seen some heavy sell days, but this is bigger than any single day. And it's like, this is warning, hey, top's near, right?
Another thing that you can't see on your chart, but if you go back to June of last year, if you can scroll back a little bit, June actually was the end of May. It was May 28th was, it is. Yeah, there's the earnings. You do have an E on there. So that's your earnings. Now, apparently, again, somebody loved what they said. The stock was flat for who knows how long prior, and that's when it popped. Now, again, is it our job to say, well, gee, I don't think the earnings were all that good? No. It's our job exactly just to see what it does.
So that's interesting there, because the surprise, the earnings as reported were 23 cents a share loss. What people expected was 24 cents a share loss. So they lost 1 penny less they were supposed to. And for that, all this starts. It is interesting that earnings come around that way. It's not always what you anticipate. Certainly not.
Plus,
it's always compared to expectations. At a minimum, that's what it is.
Plus, they may have guided forward strongly too. That's a possibility also.
Yeah, all that kind of thing plays in for sure. But so what do you think about now, Glenn? I mean, I'm looking at this stock and I'm seeing this massive head and shoulders pattern going on right now, which I don't know. It looks a little messy and kind of spread out. I'm actually a big fan of failed head and shoulders because I think they're more predictive than the head and shoulders pattern. But still, trade what you see. Here's what I see. I see this huge 3 bump pattern. You see anything there, or do you? Is that not important to you?
Well, I'm a day trader too, along with swing trading, so I do tend to look a little bit more short term. But certainly for a swing trade, we're talking about weeks and months. But I do see a double bottom there around $35, and I do look at the 50-day moving average, which is right there. So um,
That 50-day
that's
moving average on.
yeah, that is a possible scenario, positive scenario if we get some good price action.
Okay, sorry, I got to just change that moving average from the default of 9, default 20 to 50. See if we can get that. There is the little blue line in there. You see that? Okay, that's pretty light, isn't it?
Oh, I'm sorry. You know what? No, it's not the 50. It's the 200.
Oh, 200? You got a
Yeah.
200 moving average on there? Okay, let me get
Yeah.
that on. Just 200. And let me put a nice thick. Okay, and there we go. That should be much more visible. Okay, so we're approaching that 200 is what you're saying. Yeah, okay. Right, so coming down here, going to find a little support. One thing I notice about this major head and shoulders pattern is over the years, as I said, I studied head and shoulders, and I really like to look for failed head and shoulders. And what I see is high volume on the left shoulder and low volume on what would be called the head. That's not the textbook head and shoulder reversal. Head and shoulder is an upward trend reversing, and all it means is you make a higher high, higher low, and then all of a sudden here comes a period where you can't make a higher high. And that's what a trend change looks like, right? So here we failed to make a new high. We took out the old low, and that's the beginning of a downward trend, potentially. How do we know if it's going to continue? Well, does it have enough fuel and energy to do so, right? You want to see on this decline of the head, you want to see the top, the most volume. We've got a lot of volume that was bullish and wanted in at the beginning of the head and shoulders pattern. We've got a smaller amount that wants out through here. So that means there's a bunch of people here that are still committed to it. They want to stay in it. And so that's why I would think this pattern is more likely to fail than continue. And when a head and shoulders pattern fails, and by the way, all you have to do to fail is take out this first shoulder, or the last shoulder, right? So if all of a sudden we get up above, in this case, say 47-ish, if we print 47 on NIO, then you have something like a 75% chance of making a brand new high. Really high probability from that point. And the new high is high 60s, almost 70. So going from 47 to 70, I mean, there's a trade you can make some money on.
Absolutely.
So you're feeling maybe a little bullish here because of this double bottom, support on the 200. Anything else you see there, Glenn?
Well, and I agree with you too. I look for volume. Now, volumes, look, if you have a stock that's trending for a whole year, and there are plenty of them, and your volume's not going to continue to go up for an entire year. So there are times when volume doesn't make too much difference, but I agree with you. I look for volume to rise when the stock goes up, and on the consolidation to reduce in volume. So that's a big thing too. And also, you and I talk about the why all the time. I like to tell people when I mentor them, I want people to know why. Say, well, it's a head and shoulders. Okay, so why does that matter? Why does a doji matter? Why do things matter? Why? Because, just like you said, this is a change in trend. It's a change in price action. It's a change in higher highs and higher lows. For this trend to go higher, there would have had to been a higher high, and it failed. So that causes a head and shoulders, just like in reverse, it does reverse head and shoulders. So there's always a why, and it's always important for everyone to know, why do patterns represent certain things, and why do they matter?
Yeah. That's right. And you understand what drives a pattern and what is the pattern really trying to tell you. Then when the pattern doesn't behave as expected, you have a better chance of interpreting what that means. And that's actually my favorite thing is when a pattern breaks down, when a pattern fails. I look at that and I say, well, what does that mean? Usually what it means is if in fact it's a reversal pattern, it means that some people kind of got a little panicky, but not everybody. And that's a little bit of what I see here. Now, do I think NIO is about to go to 70 or 140 or something like that? No telling. No telling at all. I got no idea. All I know is it about to collapse down to under 30, back down to 10? I don't think so. I see more support in there. That's all that I can get from start of that chart. You got another one you want to look at, or something else you want me to bring up here, Glenn?
Well, I don't know how much time we have, but I did want to certainly touch on trade plan. There
Okay,
are other
great.
stocks I
I'm
like
just
to
going to
take a
bring
look
up
at.
the chart of Bitcoin here. This is Bitcoin over the weekend. As you can see, we had this big run up, and we just sort of staying in this high fluctuation range. And to me, this is like, okay, the reason cryptocurrency really matters to stock traders right now is, again, it's a proxy for risk. How enthusiastic are people feeling about taking a risk of any kind? How much do they want to put their money to work in a speculative market? The more that they want to put it to work in Bitcoin or Ethereum, the more money you're going to see come into U.S. stocks. That's the dynamic that's kind of hanging around right now. So if Bitcoin is bullish, U.S. market is bullish, not in a tight correlation, not one for one, but just in a general sense. We don't have Bitcoin really roaring higher, but it's not giving up. It's not giving up the high. It printed up there at 61,000. In fact, just a few hours ago, it retested that. So what I see here is people are still willing. They're not gung ho committed. They're not over the edge. Yeah, I'm going to do this, but they're not selling. They're not panicking. They're not giving up. Right. So they're kind of hanging in there. That's something I see now. If I wanted to make a trade, if I said I want to get in crypto now, right? So in fact, I've had people come to me because they know that I do what I do, and I've been doing it for so long that I teach people how to do it. They come to me and they say, "Hey, do you think I should get into crypto now?" But what I would say to them, I think, is what you're about to point out here, Glenn. You better have a plan. It doesn't matter whether crypto's got a good market or not. You cannot make money from it if you don't have a plan. That's the stance I always take. And why don't you give us your take on that, Glenn?
Well, look, I've been doing this for a long time. I did it before I even met up with Guy, and I've been with him for 4 years. So whenever I talk to someone and interview them or have a one-to-one with them, one of the first things I ask them is, do you have a written trade plan? And I always tell them, say, listen, don't be afraid to say no, because 90% of the people have said giving me an honest answer. So give me an honest answer. And of course they say no. 90% say no. Now, there are several different examples here. First, can you go to Home Depot and buy a Ford pickup truck? No, most likely not. Can you go to a Ford dealer and buy a toilet? Probably not. Why? Because they have a business plan. And as a trader, we trade as a business. I love to look at charts, but I trade to increase my account value. So it is a business. And what is the first goal of every business in the world? To increase value for their shareholders. When we trade, we are the shareholder. So every business has a business plan. Every good trader should have a written business trade plan. Some people say, well, listen, if I see the setup I really like, I'll know it. Okay, well, that's nice. But it's like, listen, everybody's on Facebook. And so if you're on Facebook and you meet a buddy of yours from high school, you haven't seen him for 30 years, and he says, yeah, listen, drop by, and Joe and Sam always live here, and Angie lives here too, and we'll have lunch. And you say, okay, and you jump in your car and you get halfway there and you're like, well, I don't have a map. It'd be this, I don't have a GPS. It's the same thing here. You should know in a written trade plan some very important things. First of all, how many trades you want to take. Should you take 2 or 12 or 15? How much risk per trade? And just like you were talking about risk is like the forgotten part of trading, especially for newer traders. Newer traders come to me and say, Glenn, is this a great trade? I said, yeah, it could be. And they say, well, how high do you think it'll go? And I said, I don't know. I don't know what's going to happen next week or the week after. Nobody does. If Warren Buffett came in here and sat down next to you and you asked him, he'd say, I don't know. But what do we know? We know our entry, we know our stop, and that is going to be our risk times our, position size. So should you have 1%, 5%, 20% of your account size in any one trade? These are important metrics that everybody should have. It's extremely, extremely important. Something people don't realize. If you had, say, a $20,000 account and you had some bad trades, market gets stinky and boom, you're down to 10,000. You got a 50% drawdown. And then you have 10 trades in a row and you're the man. You make $1,000 per trade and you say, wow, holy mackerel, Gordon, I just made $10,000. And then you look and you say, oh, gee, I just realized I'm back to where I started. So a 50% drawdown needs a 100% win just to get back to break even. So risk drawdowns, risk per account size is phenomenally important, and a lot of people tend to overlook it.
Yeah, it's true. I mean, the amount of risk that we put on in each trade, that is the one thing we do have control over. And we, whether the price is going to go up or down, we can't control that. But if we can control our own risk and we can stick to a plan of how we control that risk, then that is, I find, the thing that makes the most consistent gains over time for people. If they do have an idea of, I can pick out a good trade, maybe they do, but if they have 1% risk on this trade and 10% risk on that, allocating 50% risk to another thing, they're all over the map. So all of a sudden, this one trade that they put a small amount on isn't as important as this other trade. They must be not so confident in this, but totally confident in that. But what they don't really have, and maybe they can pick a good stock. Maybe they got a good track record. Out of the 100 stocks they pick 60 that go up. That's not bad. That's tradable. But if you predict which one goes up more, and you don't have a good track record for that, you say, well, yeah, I picked these 60, but among the 60, these 10 are the most important, and these 10 are the least important. Most people really stink at that kind of a track record. And I'm not talking just traders. I'm talking investors and analysts and the professionals. They really stink at knowing which one is going to be the best stock out there. And they know that. That's why they preach diversification. So you have to equalize your risk on every trade so that you don't play that game of trying to be, the magic 8-ball yourself, of just predicting everything perfectly. That's not your value. That's if the market valued you that way, then you'd be up 24/7, wires hooked to your brain, and everybody would want to know, and they'd be paying for you.
Yeah,
it's not the way life happens, and so you shouldn't trade as though that were.
Absolutely. A couple things real quick. When we talk about risk, if you want to take 2%, and you have let's say you have a flag and you're going to take the top and the bottom of the flag, don't think that 2%, if that comes in the middle of the flag because it's too deep, that you say, well, I just stick it there in the middle. It's got to be a realistic stop. It's got to be based on support and resistance. It has to be based on realistic parameters. Don't just decide to cut the thing in half and say, well, I'll just hope that works. If the risk is too great, then take a smaller position or take a different position. Also, there's a lot of people out there, Gordon, tons of people. Some are great, some are not. But I've seen a lot of times 90% profitable trades. Well, remember this, percents aren't that important. Dollar win versus dollar loss is really the most important thing. You can win 90 out of 100 trades and be up $9,000 and take that last trade or last 10 trades for 10% and lose $10,000, still be 90% profitable trades and be losing in your account. So it's really dollar win versus dollar loss. That's really the most important thing.
Well, I really appreciate your insight and visiting with us. I'd love to have you come back again sometime. I hope we can look forward to that in the future.
Absolutely. I'd love to. Thanks, Gordon.
You bet. Thank you, Glenn. All right. So winding up to the last 15 minutes, I want to show you something else that's going on with the market. This chart is an interesting little mix that I like to watch and keep an eye on. So the green line running through the middle of it is the US dollar. Okay. US dollar kind of fell over this past week, but before that, it had been trending higher. And so that's kind of a This is the inflation trade coming on here. And the people, I have noticed that a lot of people have been really concerned about inflation, and they're trading, they're making trade ideas based on the idea of the potential for inflation. And so that's a persistent theme. I kind of expect that theme to pick back up a little bit either this week or next. And you look at this in the US markets like, well, how do I profit from the expectation of inflation? The answer is the discretionary sector or the housing sector. Those are, I mean, home buying, home building, the place, and then discretionary spending, right? The place that really intersects is Home Depot, HD. That's the stock that, I mean, and it has been on a tear, just really flying high. And so keep an eye out for the Home Depot or Lowe's trade. But meanwhile, Lowe's and Home Depot and stocks like that are captured in an ETF with the ticker symbol XLY. XLY is represented on this chart as the blue line. Okay, that's the one that's really heading out at the top of the chart, right? And the red line in here is XLP. So XLY is consumer discretionary. That's where I've got money and I've got something I want to buy, and so I'm going to go spend it because I can. Okay. XLP is I got to buy the necessities of life. Even in a recession, I'm going to buy these same things. What happened? What was the big item at the beginning of COVID lockdown? Toilet paper, right? So toilet paper, the toothbrush, the medicines, aspirin, this kind of stuff is what people. So the stores that sell those kinds of things are the companies that make those kinds of things. Johnson & Johnson, Walmart. That's what's in the red line. All right. Now, the comparison between the red line and the blue line is a very important indicator of the expectation for inflation, or not so much deflation, but like, markets taken away. I mean, think of it as bullish and bearish, right? If XLY, the blue line, is outperforming the red line, then good chance the market's going to keep going bullish. If in fact it's going the other way, then we're trending into an area where the market is getting nervous and maybe getting ready to turn down, go flat or turn down. Look at this purple line. This purple line is the comparison. It's XLP, the red line, divided by XLY. So it's a relative strength comparison between what I call the need, the red line, people buying what they need, or people buying what they want, the blue line. So the need versus the want. It had been trending lower. When this thing trends lower, because it's the defensive divided by the discretionary. If it's trending lower, that's bullish for the market. If it's trending higher, that's not so bullish for the market. Not necessarily bearish, but it just means, hey, we've got a dynamic building here that is going to put headwinds to the market going higher. And as you can see, we are trending higher, although what happened in the past week is that it started going down, right? Remember the past week, Nasdaq, S&P, they went up. XLY, very strongly up over that period of time. So naturally, you're going to see this thing curl down. XLP went kind of flat, XLY went up, and dollar was coming down. So dollars coming down, that means everything's getting cheaper, there's more money going around, so that means everything's more expensive. If the dollar drops, mathematically, it helps stocks go higher, stock prices go higher, just because that's the math of it. It's like the numbers you're counting with mean less. Anyway, dollar goes down, stocks go up. That's a mathematical dynamic. Doesn't always happen, and when it doesn't happen, you care, but it did happen this past week. So that's what that downward curve on the purple line. We're going to watch this week and see, does this thing turn around? When I come back next Monday, we're going to see, did this keep going lower or did it turn around? Now, it could turn around and the markets could still go up, but that would be a very bearish signal. That would mean that, hey, we're more and more fear is building under the surface. What I kind of expect to happen, though, is that it'll continue to go down because we'll still have a pretty good week. The earnings will be good and so forth. Now, why if I think that we're going to have a good week and if we're going to have a good earnings season, why would I still think that the May 14th timeline, that day, is bearish? Why would I think that? Well, the answer is because there is so much selling. We saw the multiple months in a row where a bunch of people bought in. And a lot of that is retail traders, but not all. I mean, institutional money runs 65% of the money in the market. So if in fact the markets ran up, it's because institutions hoped it would and wanted it to. And retail traders were just along for the ride. So you've got a lot of money that is now going to be tempted to take its profit after 1 year. And that starts in May. And the critical mass comes to a head statistically after 269 to 272 days from the 1 month period. And that's May 14th. So somewhere on or around May 14th, hey, and the higher it goes up, the more we see. I kind of think earnings season and everybody putting out good numbers is just going to keep the markets going higher, higher, higher. I love that. If I'm somebody who's bearish and I want to catch the downward move, I want the cliff jump to come from a higher place because that means it's going to be a faster fall. Now, there are a lot of ways that this might not happen, and the big thing that means is simply that there will be, I can just promise you, there will be some selling. The question is, how much profit will you make from it if you try to trade it? The less of a downward move there is, the bigger of an upward move on the other side there's going to be. So either way, this is a huge opportunity. The question is the opportunity right at May 14th, or is it about a month later? We're watching both because we want to catch both of those if we can. So right here, this general dynamic of going higher actually supports the thesis of there is some fear building. Yeah. So Helen's asking, they are buying what they want towards the end, not what they need. Yes, that is right. And people buy what they want when they have money to spend, and when they have money to spend, they have money to invest, and so that's bullish for the market. That's the line of thinking there. Okay, let's see. Oh yes, we got some really interesting charts. I typically run out of time, but I got to show you this one. I did this research for the book that I wrote. In addition to the 56-week pattern research, I also noticed this. I was looking for the most reliable way to call major market tops. And what I found over the past 100 years, this signal is about 90% accurate in identifying major market tops. What you look for is 2 months in a row where the S&P 500 has been going up, but the utility sector has been going up on a percentage basis more. So 2 months in a row where the utilities, that's on this chart, that's the red line, outperform the broader market. Why? Well, utilities are low volatility, low, low opportunity stocks. They don't move around a lot. They're safety stocks. They pay a high dividend and they don't grow as fast. The company doesn't grow. So investors who are, big guys, and when they know a bad time is coming in the markets, when they themselves are planning on taking a lot of profits and selling, then they know they're probably going to be bringing the markets down. What are they going to do? How are they going to keep themselves from losing money? The answer is they put a significant amount into the utility sector. And this is a time-honored tradition. This is true going back 100 years. That when the utility sector all of a sudden gets this influx of money, there's a good chance it's because big players are trying to look for a place to hide their money. So last month, we had a very strong move in utilities. When I say last month, I mean the calendar month, March 1st to March 31st. That month outperformed the S&P. So that's just 1 month. The other indicator that has to happen in coincidence with utilities outperforming the broader markets is that you have to see an increase of volatility. That's very subtle, but we did see just a tiny little increase of volatility during the month of March. What are we looking at now? Well, utilities are going up a little in March, in April, but it's only 1 week. We're only, 1 week generally speaking, a day or two more into this market. And so this last section of the chart is not a full month. All the month of April, I'm keeping an eye on this chart, because if all of a sudden I see utilities going higher and stocks going lower, if utilities has outperformed for 2 months in a row and the average true range of the markets starts to get bigger, right? We get a lot of, we already saw that on the Nasdaq last month, a lot of days where all of a sudden the fluctuation was just, Helen, you mentioned it, right? Then if all of a sudden we see that volatility increase, and then the average true range goes up 2 months in a row, volatility increasing and utilities outperforming, that signal right there, when those two things happen together, 9 out of 10 times it presumes a bear market of 6 months or more that follows that. It's fascinating but true. And so I watch this really closely. If in fact we see utilities outperform through the month of April, I mean, that's the perfect setup to tell us that May is going to be a bad month. But usually when we see this happen, it's not, you don't see this happen because the markets are going higher and higher. The selling and the fluctuation has already started to happen. So later towards the end of April, if in fact the tech companies come in less than expected, they have worse earnings than were expected, then that's what you would see. You would see selling, you would see profit taking, you would see greater volatility, you'd see the utilities companies getting a lot more interest. So maybe that's going to play out. Don't know. I just wanted to tell you that's something you want to watch out for. This one is this is just a closer look at the utilities. So in this case here, we've got the S&P as the dark blue and the Nasdaq as the light blue, and the utility sector coming up here. You can see how that steep move happened right through the beginning of March, right? That's the utilities outperforming the others. Well, what's going on right now is utilities, they're not going up so fast, but you've got these things going up a lot faster. Okay, so that's what builds that other chart and shows you the big difference. See, last thing to point out here, yeah, this is just a look at the 4 broad market indexes. We got the S&P, the Nasdaq, the Dow, and the Russell 2000 small cap index. See, here's the old. This is February. The time frame on all of these are February, March, and April. So in the middle of February, the middle of March, we made a couple of highs on the S&P. We're way up here in the early part of April. Brand new high, just coming out the top end. Dow, similar, right? But the Nasdaq, we had this huge move to the downside, these big candles. A lot of selling happened here. I believe that this is a precursor to what's coming in May, because this is people taking profit, but people that weren't constrained by the 1-year time frame. Or if you take back, that's very literally the 1-year time frame from when COVID started. So this is people taking profit that bought in at the beginning, before COVID got going, before the pandemic got going, and they could be taking their profits that could have led to all of that selling. But it only happened in the Nasdaq, didn't really happen in the bigger stocks. So that's interesting. However, the Nasdaq tends to lead these other two, as does the Russell, because these are risk stocks. These are, so it makes sense that people aren't going to hold this for a whole year. They're going to go less than a year because these are speculators. Well, here we are with the Russell, and what are we looking at? We're down here, the February high, the March high, and we're down here. We haven't come anywhere close to the old highs. So that is not a good look for the possible going forward. I'm going to bring us back to the futures as we get ready to open the market. So this is a 15-minute chart. In the last 15 minutes, we've been coming down. I'm going to bring this down to a 1-minute chart just so we get to see the fun of the opening bell. This is the S&P 500 futures, 1 minute, and just the past 15, as you see, we're kind of coming down. This is not a large amount. We're going 41.17, 41.13. Isn't that amazing? S&P 500 over 4,000. That's guys have been in the market a long time, like myself. That's just a big number. I mean, I remember the days of under 1,000 S&P 500. So that's kind of fun, but it's all just, percentages from wherever you start, right? So anyway, here it is. We're coming down and we're just about to tick into the open. Looks like we have opened right now. What are we going to do right on the opening candle? This is interesting to me that we're not doing anything. We're just kind of sitting there. We got a whole weekend, all this stuff built up, and are people charging in and moving this up and down? No, they're just kind of sitting there. Well, okay. As the traders figure out what they want to do, what I'm telling you is for this week, you want to tread lightly. You don't want to take too much risk because there's a lot of uncertainty. It's potentially the top edge of the market. Short-term trades, 1 to 4 days, can be very profitable because at the top edge of the market, a few players really explode right at the last. And so those opportunities are going to be out there. But be careful. Don't plan on taking on large positions. I'm going to let you know when the day comes that I call my kids and say, hey, your long-term retirement accounts, move them to cash. I'm going to tell you when that day is. That day is not yet. I'm telling that, let it ride, let it ride. We're still good. Hold, brothers, hold. Right? Don't do anything crazy just yet. The countdown is approaching, though, May 14th. Between now and then, we will look it over week after week. It looks like we are actually ticking up a little bit on the markets. People dipping their toe in, trying to buy. If you dip your toe in this week, have a plan. Do it, what Glenn said. Figure out how much you're going to risk. Keep that risk to 1%. And until we talk again next week, everybody, take care and trade well.